The Santa Claus rally in the stock market begins today, and it's the last 5 trading sessions of the year, followed by the first 2 trading sessions of the following year. This 7-day period historically is one of the best performing periods in the stock market, usually up 1.3% on average for about 79.5% of the time historically. Look, that doesn't mean that'll repeat this time, but that historical track record bodes pretty well, especially since this year's a catch-up year in the stock market, in my opinion. We also just got some very good news on the inflation front this morning. The Fed's preferred inflation gauge, known as the November Personal Consumption Expenditures Index, or PCE index, came out cooler than expected and actually showed a decline of 0.1% month over month for the first decline month over month in PCE since April of 2020. And then core PCE, which is minus volatile food and energy, came in at only 0.1% month over month, which is less than estimated. Year over year numbers came in at 2.6% for the headline PCE, which is less than the 2.8% economists estimated. And then for core PCE year over year, that came in at 3.2%, which was less than economists estimated. This shows that inflation is cooling, which is good news and is something that the Federal Reserve wants to see. Look, the market might be getting ahead of itself in terms of pricing in these rate cuts. And historically, at least since 2022 and this year, whenever the market got ahead of itself with these rate cuts, the Fed usually was a little bit more hawkish and the Fed won the tug of war. Nick Timiros from the Wall Street Journal actually made this analogy. The Fed would win that tug of war. But now that we're actually seeing inflation coming down noticeably closer to the Fed's 2% inflation target, the Fed's hawkish language, if they use that, won't necessarily affect market expectations of rate cuts, considering that inflation's going down noticeably, so that the market might actually win the tug of war at this point. And then I also wanted to touch on why I think next year will also be good for stocks. Look, the Federal Reserve for 2022, it was a catch-up period, in my opinion, catching up to the very high inflation by raising interest rates by 75 basis points for multiple meetings, just catching up to the high inflation. And then 2023, it was mostly peak inflation was behind us in 2023. The Fed was still raising rates, but 2023, the Fed's language was just to keep rates higher for longer and to decrease the pace of interest rate hikes. And going into 2024, we're into a new transition of the Federal Reserve's language. And now because we're actually seeing noticeable progress of inflation going back to that 2% level while economic growth is still strong, now they're talking about perhaps when the next rate cuts are. And, the Federal Reserve said that there's a possibility of 3 rate cuts next year. And that transition of speaking about when the next rate cuts are, I think will bode very well for the market. And I'm pretty optimistic for next year.